Hi, I'm Christy Flynn.
And I'm Blake Rappenecker, and welcome back to Midwest Mortgage Mentors.
Today we are going to be talking about loan to value, or LTV. So what is loan to value? Loan to value is the difference between the balance you owe and the value of your property. So for a purchase, it is typically the sales price. And for a refinance, it's typically the appraisal amount.
So for example, if your home is valued at $100,000 and your loan amount is $80,000, your loan to value is 80%. Now in a purchase scenario, again, what you're buying your house for and what your sales contract says, typically that's what we set our loan to value calculation based on. So if your appraisal comes in a little bit higher, we're still going to base it based on the purchase price.
So why does this matter?
So this matters in a couple different areas. One being your interest rate. You see a better rate the lower your loan to value is. Another impact is your PMI, or private mortgage insurance. So obviously, again, the lower the loan to value, the better your PMI rate is going to be. Another big impact with your loan to value is for second mortgages or home equity loans. So equity loans are using the equity in your house. So obviously the lower the loan to value, the higher the equity percentage that you have that you can access to do certain projects around your house, home improvements, things like that. In a refinancing scenario, if your property value goes up over time, your loan to value is going to decrease, and obviously as you chip away and make your payments on your loan, your loan to value decreases with every payment. So
stay tuned for the next episode of Midwest Mortgage Mentors, where we discuss private mortgage insurance, or PMI.